Good morning, guys. Jim Squares here again, bringing you some more money solutions. Today, I've got something about building your withdrawal strategy for your future, and this is talking about more when you're closer to the end, or at least planning and starting to structure about how your investments are now in order to be set up for later on. So, but first, make sure to like and subscribe and share with others. And we'll get going. So, there are numerous approaches to retire. Let's explore a few to find the one that's right for you. Switch over to the spreadsheet now. All right. So here we go. This is another chart that I've built. So as I've collected things that I thought was interesting or things that I thought were really beneficial, these have been helpful things for me to think of. Hey, as we're nearing retirement or we're getting closer, what do I want to do? So now below is a chart on how investments could be allocated according to years that you expect in retirement. If you want to do something really easy, so you could segregate it into buckets. So we have, let's say I retired today. So about 5 to 7 years worth of money should be in conservative cash, money markets, something like that. And then everything else can be a moderate mix of stock and bond target date is for the rest of it. So that's one simple way of doing it. Another way, which I like better, so if you want that and you're good with that, and you're comfortable with that, just do it. And then no, you don't have to make it more complicated. If you want to squeeze a little bit more blood out of that turnip, as I like to do, then you look at this new angle risk pyramid. And this is where you go, okay, the first 1 to 5 years, hopefully that'd be a pension, annuities, CDs, and then 6 to 10 years would be income from bonds. Now that's been pathetic lately, so you might not want to do that, but then if we keep going out, then we look at, okay, 11 to 15 years, then we look at large cap stock funds, 16 to 20 years, small cap stock funds, and then 25% international funds and alternative investments. Now, why is it like this? So if you think about investing, the things out here are going to be the ones that move up and down the most, be the wildest ride, but have the best return in the long term. So that's why stock cap is out here. I would even put stock and small cap value for either international or U.S. out here. In 25 is probably what I would do, 20 to 25. I would put international funds back here, maybe a little bit past large cap stock for U.S. Alternative investments, that depends. You're going to know your alternative investment better. I can't tell you when to sell Bitcoin or when to do things like that if you have a company. I can't tell you that, but I can tell you it probably you should be planning 25 years to hold. So let's go down and see some other numbers here. So that's a good structure for how you could think of like how many years in retirement, where you want your money. You could do as simple as this, segregate the balance into buckets, or do this risk pyramid. Now, you're going, Jim, how do I know my money is safe to withdraw? So this is one that I like. I like to see like different iterations or values. So now if you just want to go some pure numbers based, there's multiple ways of doing it. So we're going to look at this chart first. So this is talking about the number of years you're going to be retired. So if you're going to be retired for 60 years, then you would want to go up and say, how safe do I want to be? Do I want to be 100% safe? So then you're going to be like 3.3% withdrawal rate. So that would be, if you have $1 million, 3.3% is like 33 grand, 33K, something like that. That's if you want to be 100% safe, like based on all the instances that have happened through all of time that we have data on. So that would be 100% safe. And we'll get into the risks. That's coming up. So, but then there's 98%. You're like, okay, I'll accept 2% worth of risk because the 2% is like depression, where I retired right after it and I had it fully invested. So that's where that one would come in. And then 95% is like, okay, am I still pretty good with 95%? And this is where the numbers, your withdrawals can change significantly. So 10% safe here. So look at how much of a difference that is. That's 10 grand on $1 million. That's a lot. So it's like, so you look at that. So it's like, okay, that's one way of looking at it. This is, I'll say, a simplified one. This is actually being revisited, and there's new studies coming out that it can be much higher. So like 4 to 5. But I don't have those in here. I go the more conservative route. So this is what I target. I'm going for these more 100% safe targets, and over long periods of time, that's where I want to go. Now, you can think of that same perspective when you read this other chart on the right. So this is where all observations. So if you're a 100% stock person, guy or gal, then for to be safe 60%, for 60 years, you need to have a withdrawal rate somewhere, at least 3%, but at most probably not higher than 3.25. So that'll match up with this. This is the same graph, but just a little bit more detailed. If you want to have a 5% withdrawal rate and you're going 60 years, 70% chance of making it based on some older data. So, and you could see the green is good, the red is bad. So if you have 0% stocks and you're going 60 years and you do 5%, you're probably not going to make it even on the newest data. So you do want stocks in here, and you could look for where 100% goes across the most. So that's where you could say 30 years, 50% stocks. And if you want to be more secure, then you'd say 75% stocks. And then here's what's interesting is it go back down when you go up to 100% stocks. So you truly do want some kind of stock and bond mix. I mean, if you want to be, I'll say, pure about maxing out the chances of you having 100% success rate, or maximizing your success rate. And it's close to 75% stocks. It's close, somewhere around there. So, and that depends on the number of years. But if you look at every year, so let's look at 100% stocks, 97 for 40 years and 98. And let's go to 50 years, 95 is 94. So that's where, that's where it's flipping a little bit. And in 60 years, it's 94% and 92. So that's where you got to be careful with this. It gets real close between these two. So, but yeah, that shows the additional risk that 100% stocks can be. If you go the longer term, you're always better like 100% stocks because you're long term. But you have to really be able to put up with, I'll say, the potential to miss out on 1 year, like having those nasty ones. Now, you're like, Jim, I'm not going to do this because we have COVID and we have all these other crazy things going on. There's no way this holds up. This stuff is just, depression. It's never going to hold. You hear people complain and whine and about all that stuff. I'll come back to that in a minute. But here's where I have a nice chart of all the crisis events. That data takes all this into consideration. That, the Great Depression, World War II, atomic bomb, Korea, JFK, Vietnam, Arab oil embargo, Nixon resigns, 20%, 2% interest rates, 50% inflation, recession, stock market crash, Persian Gulf, weak dollar, Clinton impeachment, September 11th, Iraq war, the new normal, if you remember back then, and COVID. This all in there. So if you ever get worried about your investment, just look at this and saying, is what we're going through worse than all of these? And you're going to probably go, not likely. So that's how I look at that. And that's what gives me the confidence to continue going long term on anything you buy. And even if you're not a fan of like small cap value, which I am, and you're just large cap US, look at this. Look at what's happened and the kind of returns you get positive returns over all this stuff. And this is a balanced portfolio, but that's what you truly want. So that's something else to think about. So now here is another diversified equity portfolio, and this is from Paul Merriman. I'm a huge fan of his. So here's where you can kind of see how it looks. So what it is the number of retirement failures. So the higher the bars, the bad. That's bad. Higher bars equal bad. Low bars equal best. So this is where he comes in. He says equity for allocation. So they recommend between 50 and 60%. And that's where the 5% distribution rate has a couple failures. But otherwise, based on the way they have their portfolios, which mine's a slightly, very close model of what they do. They're very heavy small cap value, 50% US, 50% international, things like that. So I'm a big fan of what they do in their work. And this is one of the better ones that I've seen. But here you can see, it does at a higher distribution rates. It doesn't, that's when the number of failures happen. And also, when you go higher distribution, or even any distribution rate, and you don't have enough equity, you're going to get killed in failures. So now, if something else to think about, and this is just something else I've captured, and I really like this chart, is, well, okay, so I'm retiring, so how do I know if it makes sense to get an annuity? And here what you can do is, let's say you have 250K, and you know what your money is, look up something called an annuity hurdle. I won't go through it other than you probably want to go with Stan the Annuity Man, and he'll hook you up. He's as far as I can find, he's the most cost-effective annuities. and this is the best data that I can find, but based on your rate of return, so let's say you get a 7% rate of return, you retired and you're good, you don't need an annuity. 6%, you're good. 5%, you're probably pretty good until out here on the edge. But then 4%, let's say you're getting less of a return, what you need to do is check like annually your balance and make sure hopefully it's not too aggressive, because if it is and you're getting close, you're better off just buying an annuity and not even worrying about the market anymore, and let the annuity company worry about it, and that'll just pay you annuity for the rest of your life. Because this annuity line, essentially, the annuities get cheaper and cheaper the older you get, and so the longer you can wait, the more annuity you can buy, and the more you're covered. So you can do that. This is another strategy that you can apply when it comes to your retirement planning. So I like that. I think that was pretty cool. I always thought I wasn't going to do an annuity, but I could see where I would check against this. Annuity would be my last resort personally, but I also have a pension, and I'm planning on Social Security, even though I don't know that it's going to be there, but I'm assuming there'll be something there. Because, it's just realistically, we've been waiting so long, and no one in the government's doing anything to fix it, which there's easy ways of fixing it, but it disgusts me, honestly. It's just crazy that we have to wait for these things. But in the meantime, I am trying to help my kids plan to assume that they don't have it. So I'm helping them, and that's where I would recommend that I four ways to 50 million. So I'm trying to help implement that for them, and that way I know that they'll be covered if the Social Security goes away, or there's a wealth tax, and they happen to be on the edge, because you don't know where you're going to be. You don't know who's considered wealthy. You don't know, like, whoever has the most votes is essentially who's going to win. So, or the most votes and the most money. So that'll be interesting to see who wins. So I don't know that I'll be on either side. So I've just tried to do the best I can for me and my family. That's what I got. Keep growing together. Share with others if you like it, and to give you some thoughts and ways of planning, just so you can kind of strategize, like, where am I going? What am I going to do with this when I have it? And enjoy. I have a copy of the spreadsheet in the notes below, so check it out, and we'll keep talking. Take care. Later.